Okay, it is just past 7 o'clock. Welcome everyone to tonight's presentation. As always, it's a great pleasure to present to you all. A little bit of background for those of you who are new. I do see a lot of new folks in the chat and in the presentation night tonight. My name is John Mantia. I have my colleagues Lauren Fulcher on the line with us today as well, and our company is Parco. It stands for Pension Americans Retirement Company, and we do retirement and financial planning for anybody with a pension, but especially federal employees, no matter what stage of their career that they're in. So we work with a lot of folks who are younger and who are planning to retire. Um, down the line, we work with folks in the middle of their career who just want to make sure that they've tied up their plans and that they're making advantage of all the benefits they have available to them, maybe if their life has changed. And then we certainly work with a lot of folks who are approaching the end of their careers and who want to make sure that they're making the most of their benefits or that they're planning for things like Social Security, um, which we're talking about tonight, and that their pension in the right way. So, a couple ground rules for tonight's presentation. If you have questions, you can ask them in the Q&A window. We've also been opening up the chat to folks. So if you have a specific question, you can chat inside the Zoom window as well. Also, you'll notice throughout the presentation, there's a QR code in the top right-hand corner. You can scan that code anytime and set up your profile on our platform at app.goparco.com and start some of the planning there. And you can also schedule a free one-on-one appointment. So when you work with us, we can get that booked on the calendar. And so tonight we're going to be talking about Social Security tax changes and federal retirement. So there was the one big beautiful bill that just got passed by Congress in July. It had a lot of implications and a lot of changes for the country, but especially for how Social Security is taxed and how to strategize around that. And so tonight we'll go through some basics of Social Security. We'll go through some concerns that people have about Social Security and some things to think about. We'll talk about some of the unique aspects of SSA. And then we'll talk about the changes that are coming from the one big beautiful bill. Then we'll talk about some unconventional wisdom. So this is going to be particularly important because federal employees are different when it comes and retirees are different when it comes to Social Security planning. We'll really hammer in on that. Then we'll go through a case study, and then we'll talk about how to get started on this planning. And then all throughout, you can ask questions, or if you have to pop off, you can create your account and schedule a time to talk to us, and we'll go through how all of this applies to your situation one on one. Okay. So let's start first by talking about Social Security and FRA basics. So, Social Security is a program that was created back in the first half of the 20th century. And it was meant to be a social safety net to help pay and provide income for older Americans. It was meant to be an extra income stream that older Americans could live on in addition to whatever they had saved during the course of their working years. So, to qualify for Social Security, you need to have 10 working years or 40 quarters where you're contributing into the program. Your benefit is based on your highest 35 years of index earnings. And your benefits then also based on your highest 35 years of index earnings. So the longer that you've been working, the more you've been paying into the program and the more that you get from Social Security. One of the first things we'll talk about tonight is something called your full retirement age or your FRA. Now, everybody on the call tonight, or I imagine most of the folks on the call tonight, are federal employees or will be federal retirees. And so you've probably heard of something called a minimum retirement age. Well, Social Security has something kind of similar, only they call it a full retirement age. So your full retirement age is the age where you're eligible to collect what Social Security considers 100% of the benefit that you've had available to you. So it's sort of like a value that you have available to you based on when you hit your full retirement age. Now, people ask us all the time, hey, what is my full retirement age for Social Security purposes? Well, if you were born in 1958 or before, the good news is you've already hit your full retirement age. If you were born in 1959, specifically that year, 59, your full retirement age is age 66 and 10 months. If you were born in 1960 or after, your full retirement age is age 67. So that's just how the full retirement age is determined. It's based on the year that you're born. So people ask us all the time, well, my full retirement age is 67 or 66 in a few months. Like, but when can I turn on my benefit? You can turn on Social Security anytime after you turn 62, and you can defer your benefit up until age 70. I guess conceivably you could defer it past age 70, but your benefit maxes out at age 70. And every month that you defer taking Social Security, the benefit grows a little bit. It gets a little bit bigger. And we'll talk about it in just a few slides how, well, that benefit does get bigger, and that's true. There is this trade off or a break even that we'll touch on here in just a few. So, what are some of the things to be aware of when it comes to SSA? Well, the program itself is a big program, right? Most Americans are eligible for and participate in it. In fact, a little bit of trivia: the reason why the FERS system was created was because of the finances of Social Security, and the Greenspan Commission wanted to figure out a way to help fund Social Security because it was running into financial issues. And so they basically determined that federal employees who previously didn't have to contribute to Social Security would start doing so. And that's what actually created the FERS system and what sunsetted the civil service retirement system, the old CSRS system. So a little bit of trivia for those of you who didn't know that. So the, that's some of the details about the program. Now, when the program was started in the 1930s, or in 1930, the life expectancy at age 60 for a individual was 78 years old. In 2025, life expectancy for a retiree has increased to 84 years old. So now you might say, hey, that's 6 years. That doesn't seem like a whole lot. Well, that's 6 more years per person on average that the program has to pay out benefits for. That's a lot of money. That's a lot of money. And so this life expectancy increase has really meant that the finances of the program have become a lot more questionable. On top of that, the demographics of the country have changed a lot. So when the program was introduced, there was about 150 workers for every one person receiving the benefit. So for every older person collecting Social Security, there were 150 people underneath paying into the system. Well, today, that number is about three and a half, 4 people. So there's far fewer workers supporting far more older folks, retirees. So when people talk about how like the pyramids become more inverted or at least a lot less pyramidal, this is what they're talking about. There's far fewer people at the base supporting each retiree, which also impacts the finances of the program. So when you think about Social Security as a benefit, as federal employees and then retirees, you have a pension, and your pension is paid out to you by OPM from your time working for the government. Well, your Social Security, when you turn it on, is paid to you by the Social Security Administration. So it's a separate benefit paid out to Americans by the SSA. And one of the unique things about it is that it's really not a legacy planning tool. So you if you're married and you're thinking about like, hey, well, if I pass away, I can leave my Social Security benefit to my spouse. There's ways that you can strategize around that, but your spouse can only collect one Social Security benefit. They can either collect theirs or yours, whichever one's greater if you're gone. So it's really meant to be an annuity stream, an income stream for you on top of whatever else you've got. And it effectively goes away when you're gone. This is in contrast to something like your 401k or an IRA or your TSP, where if something were to happen to you, that's a lump sum of money, that's an asset that you can pass on to somebody else. You can name a beneficiary. But Social Security is really meant to support individuals specifically. So I touched on it a little bit earlier, but people ask us all the time, and I imagine many of you are wondering, well, how does Social Security, how does it change over time? How does my benefit change over time? Well, let's suppose that your benefit at your full retirement age, your FRA, which was 67, was $2,400. Like I mentioned earlier, you can elect to take Social Security early or you can defer it up until age 70. So if you took it early, that benefit is smaller because you're going to be collecting it for more years. The longer that you wait to take it, the bigger the benefit is monthly, but you've waited to take it. And so there's a trade-off there. And people ask us, okay, well, and maybe you're wondering, like how do these amounts differ? Well, your Social Security at age 62 will be about 70% of what it would be at your full retirement age. Up to age 70, if you keep deferring it, it would be 124% of what it would be at your full retirement age. And if you take it any time in between there, it's some mix of in between there. You can elect to take Social Security any month. So sometimes people wonder, hey, like if I wait to take Social Security, will I only get paid based on the year that I am or how many years it's been? No, you'll get paid based on the month. So you can start it at 62 and 6 months, and your benefit will be bigger than if you started at 62 and 5 months. But it'll be smaller if you waited until you were 62 and 7 months, and so on. And if there are questions, make sure you do ask them in the chat or in the Q&A window. So, as I mentioned, if you take it early, you're going to have collected for a lot more years, but the benefit monthly is smaller. If you wait to take it, you'll have deferred, so you'll have missed out on taking money during for a certain period of time, but then when you start collecting it, it'll be greater. And so when you're comparing turning on Social Security at any one time, there's this concept of a break even, where if you take it early and you live a long time, you've missed out on money. But if you take it late and you die, you miss out on money. And so when you're comparing these any two Social Security start ages, the break even ages almost always fall between ages 78 and 80, which happens to just about be life expectancy for the average American um, upon for, uh, for the average American past age 60. So oftentimes it's obviously a financial question, but then it also can be like a longevity question, where if you have a history of longevity in your family, then maybe it can make sense to defer it. However, there are some strategies that we'll talk about in just a minute that apply to federal workers. That means that you may want to consider taking Social Security early or earlier compared to maybe your private sector family members, friends, and counterparts. Social Security also gets a COLA. So every January, this is always a big piece of news where they talk about how, hey, the SSA COLA is going to be this for this year. This is a cost of living adjustment similar to what you get with your pensions after age 62. So it does get a cost of living, and it can be a big deal to help offset some of the effects of inflation. Now, on top of Social Security, people ask us, well, hey, look, I'm working right now, or I'm planning to work in retirement, and I want to turn on my Social Security. Is there anything I should think about? Well, there is something called an earnings test. So if you turn on your Social Security or you're collecting your Social Security before you have hit your full retirement age or your FRA, there is an earnings test. And what that earnings test says is that you can make up to, for this year, they index it to inflation. You can make up to $23,400 and your Social Security benefit will be unaffected. So you could go get a part-time job somewhere, collect SSA, be getting your pension, and that's no problem. However, if you make more than this earnings limit, in the following year, they will reduce your benefit by $1 for every $2 that you make over that limit. And this earnings test is exactly actually the same earnings test that applies to the FERS supplement for those who are thinking about retiring even before Social Security age. Um, People ask us all the time, your pension distributions from annuities, from IRAs, from your 401k, TSP, those do not count toward the earnings test. So the earnings test only applies to earned income. So I know I imagine some of you had that question, but that's how that works. So a lot of background about Social Security. Hopefully you feel like you have a good sense of some of the basics around it. But now let's talk about some of the changes that have come with the one big beautiful bill. So a little bit of background from a tax perspective with Social Security. is that it has always bugged millions and millions of Americans that you pay Social Security taxes, right? If you ever look at your paycheck or your leave-in earnings statement and you see a thing on there for your deductions where it says OASDI and it's 6.2% of your wages, that's your contributions to Social Security yourself. Your employer, the government, also contributes 6.2%. So 12.4% of your pay is effectively going to pay for Social Security. And so that's coming out of your paycheck every year for decades and decades and decades. Then when you turn on that benefit, you have to pay income taxes on it. And a lot of people really don't like that. I'm one of those people. That's always a drag. And Social Security, while it is taxable from a federal income tax perspective, has always had some special tax provisions based on how much you make in retirement. And we'll talk a little bit more about that in this section. So that has bugged seniors across this country for decades. That Social Security, you have to pay income taxes on that benefit. So with the one big beautiful bill with the OBB, they have made a change which reduces the taxes that most Americans will be paying on their Social Security benefit. So basically, the intent here was to largely reduce, and for some folks, even eliminate the federal income taxes on Social Security. And so the way they're doing this, or the way this works now, is that for this year, there will be an extra new bonus deduction for those over age 65. If you're a single filer, it's an extra $6,000. If you're married, it's 12,000, and it largely eliminates the federal taxes that you'd have to pay in your Social Security check. And so we're going to take a simple example here of single Sam. He has 30 years of service. He worked for the government. He has a high three of $120,000, which we're going to use to calculate his pension. And his Social Security at age 65 will be $3,100 per month or $37,200 per year. So the first thing we need to do is look at how will the IRS perceive Sam? How will they perceive his incomes that he has coming in? Well, under the current system and under the OBB, his gross pension is going to be the same. Again, all of that's going to factor into his taxable income. But only 85% of his Social Security benefit will factor in. If you'll notice, his Social Security amount was 37,200, but from a taxable perspective, 31,620 of that will factor into his taxable income calculation. So his gross income, or his AGI, is $71,220. All of that's the same under the current situation and under the OBBB. Now let's assume Sam, like most retirees, elects the standard deduction. Then he can elect what's called the extra senior deduction, which is a deduction available to seniors that most of them elect. And then there's this bonus senior deduction that got introduced with the OBBB. So that extra $6,000 deduction reduces Sam's taxable income by $6,000, meaning that he will pay less in taxes. And we'll walk through the tax implications, the actual dollars outflowing here on the next slides. So his gross pension and his annual Social Security are bigger than the numbers on the previous slide, but they're unchanged under the current and under the OBBB. However, because his taxable income is lower, his taxes due are lower. And so his taxes effectively under this new program, based on the brackets that he's in as a single man, would mean that he would see a $1,320 tax savings for the year, or about $100, just over $100 a month, which is not so bad. So when we look at his effective tax rate, it goes from just shy of 9% to just over 7%, which when folks are on a fixed income, I'd say an extra $100 is something that I would not sneeze at. And for most Americans who don't have pensions, the tax affected savings is going to be even greater. Further, something folks don't always realize is that most states do not tax Social Security. Some of you may recognize this slide. We did it a few years ago in a previous presentation. It used to be that there were 12 states that tax Social Security, including my home state of Missouri, which I never really understood. Um, but now it's only nine. So Vermont, Rhode Island, Connecticut, Minnesota, North Dakota, Montana, Utah, Colorado, and New Mexico are the only states that tax Social Security on a uh, state income tax level. So we've gone through some of the basics of Social Security. We've talked about how these OBBB changes affect federal retirees, but or affect Americans when it comes to their Social Security. But now let's talk about some of the unconventional wisdom and why the Social Security strategies for federal workers and federal retirees can be a lot different than it is for most Americans. So the big question that people ask is, hey, like, should I defer or take my Social Security upon retirement? Hey, I'm retiring at 63. I'm retiring at 64. Maybe I'm taking the DRP or there's a VERA being offered, or VERA is maybe a less relevant example for tonight's presentation. But I'm listening to the radio. Everybody on the radio tells me I should definitely wait to take Social Security. I should definitely wait to take Social Security. Everybody on the radio is saying I make 8% a year to wait. My friends are saying they're going to wait to take Social Security. I should definitely stop. Well, or I should definitely wait. Well, one thing to note is that you've probably heard Parco say this 100 times before, but the folks we work with are different. Federal retirees are different because you guys have pensions and you guys have benefits you get to keep into retirement, like your 401k, your TSP, IRAs, FEHB, all these extra things, FEGLI, you get to take with you in retirement. For most Americans, retirement is a really, really, really scary thing because they will rely solely, or from a huge portion of the American population, they will rely solely on Social Security for their income in retirement. That's the only source of income that they'll have. So if that were the case, imagine that you were not a federal retiree, you didn't have a pension, you didn't have these retirement benefits offered through your employer, and you're thinking about retiring or not working, you would probably say, yeah, I need to wait to take this as long as possible because I need this benefit to be as big as possible because I've got to make sure that I have the money that I need to live, to buy groceries and pay my rent or pay my mortgage or do all those things in retirement. Well, for federal workers, that's not necessarily the case. You have a lot more dynamicism. I'm going to regret having said that because I know I didn't say that right. Dynamism in your planning. So let's take a case study of an individual who's thinking about retiring at 62. Right, he's actually going to retire today. Frank is 62. He's retiring today, and his pension is going to be $1,980 a month. And he knows that his Social Security benefit will be $1,800 at 62, just shy of 2,300 at 67, and almost 2,900 at 70. And he's wondering, when should I turn on Social Security? We'll assume that if he invests his money for the long run, he'll get 7% on his money. He's currently used to living on $4,767 per month, which is what he would like to take home in retirement. And he has $500,000. This might sound like you or somebody that you work with when it comes to the situation. And he's wondering, what's the best way to maintain my lifestyle in retirement so I can go on cruises, I can fish, I can visit my grandkids, do all those things that I love to do, while at the same time maximizing the amount of money that I leave behind for my beneficiaries and for my family. So the first question we have to ask is, what additional income will Frank need to maintain his lifestyle? Well, he has his pension of 1980. Let's say his Social Security will be $1,800. He has a gap there of about $987 per month that he would need to bridge. So let's say that's his target, that 987. If he waits until 67 and doesn't turn on his Social Security, he'll have to take withdrawals to bridge that gap of 2787 until he turns 67 and can start turning on that Social Security and has to withdraw from his balance less. And it's a similar case if he's 70. So if we're trying to set up the planning, if Frank takes his Social Security at 62, he can set aside just about 60% of his balance for income for the rest of his life and leave about 40% for growth for the long run. If he waits to take Social Security until he's 67, he's going to need to set aside some money for income distribution when he turns 67 to supplement his income on top of his Social Security and his pension after age 67. He'll need to set aside another bucket to bridge that gap for the next 5 years to make sure that he has the money that he needs to pull on. And then he can confidently invest the rest for growth and for lifestyle or for legacy for the future. And if he waits till 70, he has to set aside even more for that 8 year period when he's waiting to take his Social Security, and a smaller amount for that income post 70 on top for supplemental, and then an even smaller amount for legacy planning. So when he walks through these permutations, if we assume that he lives until 85, let's say it's sort of like a normal life expectancy, if he takes Social Security at 62, given how much he can set aside, assuming a 7% growth rate, he can leave over three-quarters of $1 million behind. If he waits to take Social Security at till 67, he can still leave behind a legacy, but it's smaller. And same story if he's 70. So sometimes we like to flip it and say, well, look, if you're retiring and you have the option to either spend your own assets, spend the assets you've accumulated over the course of your life that you can leave behind to somebody else, or spend the government's money, which is basically what the Social Security benefit is, well, it's worth considering taking the Social Security, pulling far less on your investments, because then you can do a lot more with those. You can do a lot more with those. And that's something we help people plan around every single day. So we're thinking about like kind of like to wrap up with some of the checklists before I get to some of your questions tonight. The first thing I would recommend everybody do tonight, if they haven't already, is get your SSA statement from ssa.gov to get a sense of what your benefit will be at all their different ages 62, 67, 70, all that stuff. You can actually upload that document to your GoParco or your app.goparco portal into the platform, so you can always have it there to view. Also, plan your retirement date and evaluate different scenarios, especially if you're closer to retirement or you're now in the retirement red zone and eligible. Figure out whether or not it's worth to stay and if you're going to pull from SSA or from your investments or a mix of the two. Create an income and asset allocation plan. Make sure that you're invested in a way that makes sense for your long term goals and future. And then you can get started by creating your account on app.goparco.com, and you can schedule a free one on one to meet one of our teammates to help you strategize this in your situation. Because we know these things are confusing. We know there's a lot of questions that people have. And that's why we built our platform to help you do some of this planning without needing to do it on your own. So with that, I do see a lot of questions coming through both in the Q&A and in the chat. So I'm going to answer any questions that you all have. And please, if there's anything that I can do to be helpful, please let me know. So there was a question, I know some of you can probably see it in the chat. There was a question about Social Security being taxed in different states. So it's always interesting. There's some states that don't tax income, period. Places like Florida, Nevada don't tax income at all. There are some states that tax income but exempt certain types of income. So the most common one is Social Security. Most of the time, most states don't tax Social Security. There's other states that'll exempt pensions. They'll say, hey, look, we don't, if you have pension income, we don't tax that. There's some states that will exempt government pensions. So if you work for the federal government or you work for a state government, some of those times those are exempt from state income taxes. So it just depends on the priorities of those states. And we know this can all be very confusing. That's why we've been building our platform to help strategize all this stuff for you all. Also, we asked in the last webinar too of the audience if there's any topics that you would like us to cover. So, for instance, the OBB webinar tonight came about because we had a lot of folks asking us about, hey, how does this affect my Social Security and retirement? So we wanted to present it last week, and we did an encore tonight. We've had some folks asking us about RMDs, Or hey, can I get a mortgage in retirement? Or hey, how should I make sure I maximize the amount of money I leave behind to my beneficiaries? Or hey, how do I guarantee my income? Or how do I make sure I don't run out of money? And what do I do with life insurance? If there's specific topics that you would find interesting, let us know here because we listen to you. We do these webinars every Wednesday night with the intent of making them really valuable for you all. And then we'll also always upload them onto our YouTube channel the next day. So keep those ideas and questions coming. So I know there was a question also about, okay, I see this one about how, is this a permanent tax change? Is this new bonus senior deduction permanent? So it has not been made permanent. It lasts through 2028, but there's no guarantee that it will continue. But there's also nothing that would prevent them from extending it if Congress has the appetite to do so. And generally, they don't like raising taxes on seniors. So um, I think it could become a political thing down the line. I see a lot of folks on the webinar tonight. I know a lot of you all have created your Parco login and your Parco portal. Hopefully, you're all finding that very helpful. Um, and we're always trying to make that better for you and more useful. If there's other features or other analyses or other things you'd like to be able to do, our vision and goal is to make this the best retirement planning experience that you can have because we think federal employees deserve it. So if there's anything we can do to make it good, we're doing so. All right, I'm going to stay around for just a few more minutes just to answer any more questions that come through or um, get any more of that feedback people have been having with different suggested webinar topics. Oh, okay. This is a really good point. Um, Deborah mentions IRMA or the basically like an extra tax for folks who earn a certain amount in retirement. Um, that is a really good topic. That is a really good topic. Deborah, thank you so much for mentioning that. We will definitely add that to our list, and I could definitely see us doing that here in the next few weeks. Um, Definitely see us doing that in the next few weeks. All right, I'll just give it just a few more minutes because I know a few of you are providing some ideas. And thank you all for the compliments too. It's always a pleasure to present you all. All right. Well, if there's no other questions, it looks like we've got some great webinar topics coming down the line. You're all on our email list, so you'll see those come through. If there's somebody that you think would find this valuable, forward it around to your friends. We'd love to have way too many people on the webinar and be Have lots and lots of questions and stay here till 9 o'clock, answering every situation. So, as always, everybody have a great week. Stay cool, and we'll see you next week for our next topic. Be well, everybody.